Dhiren Sarin from Barclays joins us on the show. Dhiren, hi. The Fed's decision to roll back QE has helped the dollar strengthen. Do you see more gains for the dollar from here as the Fed continues to roll back?
Yes, I think the dollar gains we are seeing are quite independent of what the Fed is doing. I mean, the Fed has been on the pedal and off the pedal and on both directions for the last few months now. Initially, the tapering calls were pared back from January to March and so on and so forth. There's been a lot of mixed sentiment around this, but the one consistent trend through all this mixture is dollar strength. So I'd like to separate the trend of dollar strength from what the Fed is really doing and take a bigger picture look at US yields themselves. What we're coming out of is a multi-year downtrend in US yields, and there's a squeeze to the top side in yield. The market had gotten very long. There's position liquidation, not just in the short term, but in the medium to long term. This allows for higher yields and a higher US dollar, almost regardless of what the Fed might be doing here.
Dhiren, so what do you think will be the pace of the rollback, and when do you see the QE program end?
Well, the pace of the rollback is likely to be slow. Now, the way we look at this is looking at how yields move. Now, the market takes a long time for yields to form a base. If you go back and look at previous crisis events when yields dropped, it takes months, if not years, for yields to form a base and start to push higher. So we do think that yields can start to push higher, but it's going to take some time. It'll take several months for that 50 to 70 basis point move to unfold, and we do think that this will happen over the course of the year. Now, whereas QE is going to end, I think that's a different point here, because we'd like to focus where the money lies, where the investors are focused on, and that's US yields themselves. And you find very often that markets lead what the Fed might even do. So let's keep our focus on US yields first, I think, and just maintain that upside focus towards the 370 to 4% area later this year in US 10-year rates.
So, Dhiren, what's your outlook when it comes to US equity markets?
US equity markets, we're looking towards 2000 in the S&P 500. We've been bullish for the last 2 to 3 years. We just don't think that the upside will be as straightforward this year. It's going to be more erratic. We're looking for a correction, a pullback, somewhere late Q1, Q2, when bearish seasonality kicks in. But into year end, we do think overall that the S&P will do quite well, and we would like to stay medium to long-term bulls, looking at 2000 if not higher.
So, Dhiren, looking at currencies again, how do you see emerging market currency to pan out for 2014?
Emerging markets are the biggest losers here in this reallocation of assets back into developed markets. What we found after the credit crisis, which was of course sparked by the West, a lot of the assets got shifted into EM eventually in the initial phases of recovery, but all that is going to be soaked back and absorbed back into developed markets. So we think EM FX ends up being a loser here. Now, in terms of dollar INR, we had a big run up last year, so it may not be dollar INR this year, but we are starting to see some cracks, some fissures in the likes of dollar Thai baht, dollar Philippine peso, which are starting to push higher quite sharply. And just very recently, yesterday, we saw dollar Mexico, the Mexican peso, start to weaken quite strongly and stage some breakout signals. So we're looking at sort of weakness in Mexican peso, in Chilean peso, in the likes of the Turkish lira, Thai baht. So you can definitely look at a lot of cracks occur and EMFX fall apart here. I'd be cautious on this one.
Dhiren, finally, what's your view on emerging markets, and do you see reduced fund flows to regions as developing markets strengthen?
This has all been driven by bond flows, so we do think there's going to be reduced flows into the bond markets in EM, and to that effect, even some of the FX markets get hurt, because FX happens, bond markets often are very well FX hedged. However, if you look at equity markets, they're looking all right, and they're well supported by the fact that a lot of the equity sectors in the US are doing quite well. The Dow Transports, the tech sectors, and I think this has knock-on effects in EM markets, where EM gets a natural buoyancy in a lot of the equity markets. So really, we should watch out in FX and bonds, but I think the fund flow into equity should remain pretty stable, if not better.
Dhiren, good chatting with you. Really appreciate you taking the time out and speaking with us today.